Ladies and gentlemen, good day and welcome to Himatsingka Seide Q1 FY23 post-results conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Jhunjhunwala from Elara Securities Private Limited. Thank you and over to you, ma'am.
Thank you, Vivian. Good evening, everyone. On behalf of Elara Securities India Private Limited, I would like to welcome you all for Q1 FY23 post-result conference call of Himatsingka Seide Limited. Today, we have with us the senior management of the company, including Mr. Shrikant Himatsingka, who is the Managing Director and CEO, Mr. K.P. Rangaraj, President Finance and Group CFO, Mr. Dilip Panjwani, Executive VP and CFO, Strategic Finance, and Mr. Sachin Garg, Senior VP, Strategic Finance. And I now hand over the call to the senior management of the company for initial comments. Thank you and over to you, sir.
Thank you, Prerna. This is Rangaraj. Good afternoon, ladies and gentlemen. On behalf of Himatsingka, we would like to extend a very warm welcome to all the participants of the Q1 FY23 earnings call. As always, I'll first take you through a business update followed by comments on financials, and then we'll open up the floor for Q&A. I start with a business update. Q1 FY23 performance was adversely impacted due to the unprecedented levels of high raw material prices, inventory correction being undertaken by major retailers across markets, softening of demand, and continued supply chain disruptions. As a result of the above, capacity utilization across our plants was impacted during the quarter. The capacity utilization levels for our manufacturing facilities during the quarter stood at as follows. Terry Towel division was 54% against 72% in the previous quarter. Sheeting division recorded 55% capacity utilization against 79% of the previous quarter. Spinning division recorded 78% against 101% of the previous quarter. During the quarter, revenue stream from brands stood at rupees 439 crores versus 582 crores during the previous year and rupees 548 crores during the last quarter. We expect to have a challenging first half of FY23, mainly on account of the inventory correction initiatives being undertaken by major clients across markets and the unprecedented levels of inflation across raw materials, energy, and supply chain costs. However, we expect progressive improvement during the second half of the fiscal, driven by the anticipated lowering of inflation levels with the arrival of the 22-23 cotton crop and the normalizing of demand as the inventory correction initiatives are complete. I now move over to the financial section. Consolidated total income for the quarter stood at rupees 679 crores versus 820 crores in the previous year. This represents a decline of 17.2% year-on-year. Consolidated EBITDA for the quarter was rupees 52 crores versus 163 crores in the previous year. The EBITDA margin for the quarter stood at 7.7%. Consolidated EBIT for the quarter stood at 10.79 crores versus 125 crores in the previous year. Consolidated PBT for the quarter was a loss and stood at 58 crores versus profit of 82.68 crores in the previous year. The interest cost for the quarter was higher due to the completion of the subsidy period under the state incentive scheme and on account of provision we had to record for on TUFs as per the printing policy. Consolidated PAT for the quarter was a loss of 54.73 crores versus a profit of 57.7 crores in the previous year. Debt profile. The consolidated gross debt as of 30th June stood at 2,977 crores compared to 2,805 crores at the end of 31st March 22. The total term debt stood at rupees 1,730 crores and the total working capital debt stood at rupees 1,247 crores. The cash and cash equivalents as on 30th June 22 stood at rupees 179 crores. In addition, the total amount of unsold ROCTL scrips stood at rupees 188 crores as of 30th June 22. Consequently, the company's net debt outstanding as of 30th June stood at rupees 2,797 crores compared to rupees 2,629 crores as of 31st March 22. With this, I complete my update. We would be happy to take on your questions now. I would request Mr. Himatsingka, our MD and CEO, to answer your Q&As. Thank you very much for your patience.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We request participants to kindly press star 1 to ask a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, kindly press star 1 to ask a question. The first question is from the line of Vikas Jain from Equirus Securities. Kindly proceed.
Thanks, sir, for the opportunity. My first question, you mentioned about the reason for the higher interest costs as to like a completion of the state level incentives. Can you give some more color about it? And is it like continuous means the interest cost will continue to remain at the current level going ahead as well?
Because the provisioning we have made as per our internal provisioning policy, because the government of India seems to be late on reimbursement of interest subsidies under the erstwhile TUF scheme. So the impact of that is approximately 8 crores for the quarter. And so that should not be a recurring cost. And as far as the state incentives are concerned, I would request to take that offline and we can give you more details on that front.
Sure, sir. There were also some sale of assets that we carried out and we did around 18 crores of that income in our other income. Can you give some color as to what were those assets?
This was just it was an ordinary course, let's just say, disposal of assets. We wanted to actually upgrade some of our assets, so we thought that we'll get rid of some of our older generation assets. It's a small quantum, but it's essentially undertaken for upgradation reasons.
Right.
So, as the note suggests, the book value of the assets are close to nil, 2-3 couple of crores, and we had a gain on sale of assets on that front. And that we use the proceeds for upgrades.
Correct. So, and the last question with respect to the overall demand scenario means, can you give some guide as to what are your feedback when you're interacting with the retailers now? Has the end customer started lifting of the goods, or how is the scenario from their side? And when do they expect normalization kicking in?
That's a very pertinent question, Vikas, and I'd like to take a few minutes to answer that. So, FY22 was a record year in terms of revenue for Himatsingka. We had a very stable, revenue stream across the 4 quarters, and we ended the year with just over 3,200 crores in consolidated revenue. The sudden, let's just say, movement on the demand front is something that surfaced, much later in Q4, and it was difficult for us to read at the time as to how severe this inventory correction initiative is going to be. Because up until February, March, we didn't see any major correction signs at all. It was only, in late Feb, March that we started seeing some signs, but we didn't realize at that point, or we weren't sort of having the visibility at that point about the inventory corrections that were awaiting us and the industry at large from major markets. So the first point is, while we had a record FY22 in terms of revenue, we had a sudden dip in demand surfacing in the first quarter. And as Mr. Rangraj pointed out, we are likely to have a challenging first half, essentially driven by these two factors. A, the correction in demand largely emanating from the inventory correction exercises being undertaken by clients, and B, the continuing levels of inflation across raw materials, energy, and supply chain. So these are essentially the two challenges that we are faced with. As far as the demand is concerned, we feel that we are beginning to see some relaxation of this inventory correction exercises that have been undertaken, and we should hopefully, at this point, be looking at some progressive improvement starting from Q3 is what we anticipate at this point. Do keep in mind that the markets are volatile and extremely, let's just say, not transparent. But to the best of our knowledge and as far as we can see, we see some, progressive improvement on the demand front commencing Q3 and then headed to near normalizing of demand as we go forward. We've also been tracking the underlying sales of our products across bedding and bath categories. And the underlying sales of our bedding and bath categories are not as hit as our top line suggests. Therefore, it is safe to assume that the bulk of the correction in revenues is coming from the inventory correction that our clients are undertaking. As far as inflation levels are concerned, it is largely coming out of cotton, which is the bulk of the hit. And we feel that with the arrival of the new crop in late September, early October, we should see the prices cool off. Do keep in mind, cotton has never behaved in this manner in history. It's quite honestly something that was not expected, and certainly it was not expected to carry on as long as it did. So even as we speak, the commodities, the commodity of cotton is extremely, let's just say, expensive vis-a-vis its normal levels. And I think the earliest it will begin to cool off is with the arrival of the new crop. So these are our views on the principal concerns of inflation and on the normalizing of demand. As I said, the underlying sales of our products are not as badly hit. There are some corrections in single digits on an average that we've seen, but nothing as major as we are seeing in the first quarter because it's being driven by the inventory correction that's being undertaken.
Right. So the last question with respect to our capacity addition plans that we have, what are the thought process as of now and any timelines attached to it?
I'm sorry, could you repeat your question? What plan?
The capacity addition plans in a sheeting business, what is your thought process now?
So, because as I shared with stakeholders during our previous call as well, we have put on hold any further capacity additions at this point, given the volatility of macro, given the macro volatility being witnessed across major markets. So, we have for the here and now put on hold any further capexes for debottlenecking of capacities. As and when we have the confidence of higher visibility, and as and when things normalize, we will, circle back to our stakeholders on how to take forward the debottlenecking exercise, both in sheeting and bath. But until then, we've decided internally to put it on hold.
Sure, sir. Thank you for the answer. Thanks.
Thank you.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Prerna Jhunjhunwala from Elara Securities Private Limited. Kindly proceed.
Hello. Thank you. So just wanted to understand the demand scenario in US and non-US. Is it any different or is it similar across geographies?
By and large, Prerna, across major retailers, in a range-bound manner, is pretty similar. We don't see many exceptions. There are some retailers who have largely completed their inventory correction exercises. That's something that's positive. And we are seeing them go back to, their older levels of offtake or near there in a range-bound manner. And there's the others, who are still work in progress and working through their inventories. We've also seen, very many retailers who have been given clear mandates by their management to substantially, reduce the inventories they have on hand and on water. And this clear direction is something that we've seen across various clients. So I don't see much of a difference between US and non-US in terms of approach.
Okay. And sir, we've also seen this inventory correction cycle earlier in 2018-19 period by the retailers. Is the situation severe than that, or is it similar to that?
No, I think, Prerna, the 18-19 must have been a little more ordinary course. I don't recall if you're mentioning 18-19 in context to Himatsingka or context to the industry.
Industry. The inventory correction taken by the retailers in 2018-19 period. FY19 is what I recall.
To my recollection, that was mild. That might have been, in certain retailers. I don't recall that to be a sort of industry-wide phenomenon, to the best of my recollection. But this one is clearly an industry-wide phenomenon, and it's severe. So the one that you witnessed earlier is not comparable, to the best of my knowledge, to what's going on.
Okay.
We have been in this industry for 15 years, with our unit commencing production in 2007. We've never seen something of this nature earlier. Neither have we seen anything of this nature on the inflation front, nor have we ever witnessed something of this nature on the inventory correction front.
Okay, understood. So, in terms of cotton inflation, that you're seeing that there will be some correction coming in from when the arrivals come in, do you think there will be price correction even from from your customers' side, that they are asking for lower price before starting their offtake, or how is the industry behaving at this point in time?
Good question. Now, it will be a case-to-case basis, because the clients have given, let's just say, differential price increases across products and across categories. So it's not like their increases have been uniform, right? So they will take a case-to-case approach, is my guess. However, I think there is an implicit understanding that if cotton corrects from here, to some degree, to some certain extent of correction, I think that they will understand that price decreases are not warranted because they were not funded in the first place. So, I think to a certain extent, the correction will be a correction, and stakeholders, in this case, clients will understand that, they cannot expect a decrease in price. Having said that, there are pressures for them to normalize prices, and there could be cases where they do request and/or press for some reductions, if not pro rata to the cotton reduction, at least some reduction in prices that would help them sort of normalize their pricing as well. So it's going to be a case-to-case phenomenon, but I think that it will not be the reduction in cotton, as it's expected to happen, will not be a neutral phenomenon. It should be a net benefit, because we have, as an industry, borne the impact of the inflation far more than what clients have compensated us for.
Yeah, completely. The industry understanding is about approximately, to a very large extent, most of this increase is not compensated post-March, is what I understand. So one more thing, in terms of demand, how is the demand in premium versus mass segment? Because of this high increase in cotton prices and inflationary trend, there has been price increases at the retail end as well. So have the consumers started down trading in lower variety of products? And how are we placed in exchange of that in terms of those categories? And given the current cost structure or expected decline in cost structure, how do we benefit or suffer in this scenario is what I wanted to understand.
So Himatsingka, specifically speaking about Himatsingka, we are well balanced across, let's just say the lower end of the pyramid and the upper, sections of the pyramid. As popular perception sometimes within stakeholders is that Himatsingka is only in the premium end of the market because of our brand profile or things of that nature. But the truth is that we are well balanced across, across price points. And we have not seen any noticeable and or reportable, patterns in offtake vis-a-vis products at different price points. So, in other words, it's not like our higher end products demand has fallen disproportionately to our more attractively priced products. That doesn't seem to be at least our experience. There could be, again, exceptions to this at a program level or a product level, but it's not definitely at a category level. And so I think all price points are, sluggish at this point. Himatsingka is, I would say, we have a fair amount of weightage in the lower end of the pyramid, and we've, on a positive note, been working through last fiscal on enhancing our client base and our product basis as well, which was also partly responsible for the revenues that we saw last fiscal. So as far as we are concerned, we are seeing a balanced movement across price points, and I think the recovery will also be of that nature, plus minus. That's my broad reading. The company continues to be focused on making sure that we are bringing innovation to the market, whether it's through brands, whether it's through other forms of innovation. We are also continuing to expand our channel presence on channel mix, across big box and department stores and off-price and specialty chains and digital platforms. So that whole push, broadening our client base push, we already have a pretty strong brand portfolio. We are also focused on a lot of private label. We continue to obviously be, amongst the leaders in the industry. We had this past year won the silver, Textrosil silver for both bedding and bath. And we actually were equally focused on the ESG front during the fiscal, because a lot of our international clients are, equally concerned on ESG initiatives. And I'm happy to share that Himatsingka had the highest Higgs Index score for its manufacturing campus at Hassan in the industry, and it was amongst the highest rated in the manufacturing sector as a whole in the country. So, our focus on all these things, be it clients, be it price point balancing, be it category balancing, be it ESG, all of these things remain strong, but we have to get over this hump of inventory correction and unprecedented levels of inflation for our operating performance to normalize.
Thank you, sir. That was quite elaborative. I have few more questions. I will get back in the question queue again. Thank you.
Sure. Thank you.
Thank you. Participants who wish to ask a question, kindly press *1. The next question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Kindly proceed.
Yeah, thanks for giving me the opportunity. So my question is again on the demand and the capacity utilization you will be expecting in the second half. So as you mentioned that progressively you are expecting demand to improve in the second half and this inventory correction will get over. So, in that context, what will be your capacity utilization in the second half of the year? Should we expect it to improve to about close to 70%?
Yeah, directionally it should head there, Kaustubh, but I'm being entirely open as I always am. It's unfortunate that the normal levels of visibility that the industry typically enjoys is not something that's on the table at this point. So while Himatsingka doesn't give guidances, and we historically have not, so I wouldn't have answered that question for you even when things were normal. But it would be safe to assume that, our capacity utilizations have been either range bound or inching up progressively over since we have expanded our capacities. In this situation, I'm a little cautious on giving you more definitive figures for obvious reasons, given the volatility that you're seeing around us. So I'd like to, stick with our progressive view for the second half. And progressive is, directionally speaking, heading north. Now, whether it's 70% or 60%, it's something difficult for me to say, but we hopefully should see progressive movement going into the H2 of the fiscal.
Right, sir. So my second question is on the debt levels. As you mentioned that currently your gross debt stands close to 3,000 crores. So should we expect this to increase further, or should we expect it to remain at this level, and over the period of time, once your cash flows improve, you will be focusing on reducing the debt on books?
Yeah. So, Kaustubh, unfortunately, our efforts on deleveraging have not borne fruit for one reason or the other. Right. And I have no hesitation in admitting the fact that, we are behind, schedule insofar as what we had sort of spoken about in deleveraging and what we've achieved. This has largely been this post-COVID phenomenon, which has, made it very difficult for us to to address that issue. As we see it at this point, our leverage levels are something we are absolutely working on. It will have to go south from here. Whether it will, increases in debt levels could happen even because of rupee movements, translation, and things of that nature. So barring such ordinary course movements, directionally we have to make sure that it goes south, which is what we are working on. And, we will be working on basically 2-3 initiatives. A, making sure that we sort of head towards normalizing our revenue streams, as I just discussed earlier, which will be driven progressively, on the back of normalizing demand. Of course, there's macroeconomic volatility that sort of surrounds us, but, at an industry and product level, it should progressively become better. We are working on cost optimizations across board, given the inflation levels that the industry is seeing. And, there are times where after a bout of inflation, things never go back, in terms of commodity prices, they don't go back to where they began from. So if I look at a pre-COVID cotton price and the cotton price at this point, our expectation is that cotton will not correct to levels that it was pre-COVID. So we are recalibrating our cost structures to align with the new realities of input inflation. So, normalizing our revenue streams, optimizing our cost structures, driven by various factors. And the third bucket will be rationalizing our intense working capital requirements, which we believe need work. And we are working on it. Once again, it's one of those initiatives which aren't bearing fruit because of the volatility that surrounds us and the incessant inflation that was witnessed during this time. But that remains a central theme of focus. So with all these 3 buckets, we should be able to, in the medium term, work on our leverage levels coming down. So in the term, there could be some movements, but we made sure that we are actually focused on this, and we are making sure that we at best hold it and take it down from here. But then again, there could be marginal movements in the ordinary course.
Right, sir. Thanks for the detailed understanding. My last question is on if India manages to sign a free trade agreement with UK. So how will it be beneficial for us? Because garment manufacturers are quite gung-ho about it, and they are anticipating good shift happening to Indian market. So in that context, how it will be beneficial for home textile companies like us?
It's a good question. So it's a much anticipated move, and the signing of the FTA with the United Kingdom. From what one hears in industry circles and from the media and what's available in public domain, the likelihood of this FTA being signed is reasonably high. And should it come through, it's going to be a boost. Boost is a strong word. It's going to be a positive development for the home textile industry. I can't comment on the garment and apparel sector, but for us, I think it will be a positive development. Will it result in, will it result by itself in double-digit revenue growth or anything of that nature? I don't think so. But it will be a positive development insofar as a big market, which is thus far been focused on buying goods from other jurisdictions where they have duty advantages. The UK will rethink its sourcing strategy, as we have been told by several clients, and a lot of that share will come to India. Now, while we are on that subject, it's not just the FTA that could cause a positive movement for the industry. It's also the China plus one that's playing out and could continue to play out going forward. It's not a theme which has a limited shelf life of 6 months. It's a theme, the China plus one theme, as far as our industry and our sector is concerned, is a theme that's going to play out in the medium term. And when I say medium term, I'm talking about, the next, it's not the next 3 months, it's going to be playing out for the next couple of years at least, if not more. And there seems to be, let's just say, several reasons and criteria that, when examined, give India a strong footing to garner more market share. So that's a theme playing out. The FTA theme could also be playing out as we go along. The inflations will be tamed. The inflation levels will be tamed with the new crop in all likelihood. And we will once again be headed to, as an industry, to normalized levels of operations. Himatsingka's medium-term view on the industry and margin profile and things of that nature remain intact at this point.
Right, so thanks for the understanding and all the best for your future quarters.
Thank you very much.
Thank you. Participants with questions, kindly press *1. The next question is from the line of Mithun Aswat from Kiva Advisors. Kindly proceed.
Yeah. Hi, sir. Just wanted to understand, you did mention in the second half things should start improving as the new crop comes back. I just wanted to understand, within the current quarter, the second quarter, do you see things improving in terms of demand compared to the first quarter, or would it be more of the same even in the current quarter?
As we've said, even in our business update, Mithun, and once again, we'd like to be sort of transparent and clear with stakeholders on this front. We believe the first half is going to be challenged. So Q1 has been challenging. I think Q2 will also be challenged. And we will see progressive, I harp on the word progressive improvement as we see things at this point. We could see progressive improvement starting the second half of this fiscal. The improvements vis-a-vis the arrival that will sort of be felt with the arrival of the new crop is the softening of prices, because fresh supply will come into the ecosystem. So that's what the contribution of this crop will be when it hits the markets. But it's not necessarily correlated to demand. We can have a situation where the crop hits the market and the demand continues to be subdued. So our forecast is that we are likely to see progressive improvements, because a lot of the inventory correction exercise is being undertaken by global clientele, hopefully would subside in its intensity as we go along the future. I hope I was clear, Nitin. Would you like me to once again share this with you, or?
No, I've understood what your expectation is. I'm just trying to understand in terms of yeah. And second, the second point is we will see progressive improvement. So it's not something that we have entirely, we don't have entire visibility to at this point, but we are seeing some green shoots with the inventory correction exercises coming to a close, at least with some clients, and therefore that should help in driving up some demand. So that's why we use the word progressive. And while the demand progressively moves up,
The other challenge that we in the industry are faced with is the cotton issue, and that part hopefully will begin to cool down with the arrival of the new crop.
Sure.
As you all know, the cotton season runs from October through September in India. So beginning October with that crop, hopefully there will be some respite on the prices.
Sure. Thank you.
Thank you.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Prerna Jhunjhunwala from Elara Securities Private Limited. Kindly proceed.
Thank you. Sir, I wanted to understand the revenue share from non-US regions, largely because just wanted to take an to take an understanding about the PCG strategy that you had embarked on 2 years ago of increasing product, clients, geography. So you mentioned about it in my last question, but if you could throw some numbers around it, it would be helpful to understand the progress on that.
Yeah. Prerna, I think what you could do is just sort of get in touch offline, because that's actually a host of questions and interlinked queries, which will be difficult to answer just off the cuff like that. So if you could do get in touch, and we'll sort of connect the dots for you.
No. So one bookkeeping question on depreciation. Our depreciation and amortization expenses have been increasing on a Q-on-Q basis. Now that we're not doing any major capex activity, what is the reason for this increase?
This must have been some capital work in progress that's got capitalized. But you will see very marginal, small movements, nothing of any consequence. And our current capital work in progress is probably, extremely small. Probably it will be sub 50 crores. So there's not much more to come.
Okay, understood. And sir, what is the reason for us spinning capacity utilization being lower? Because anyways, we were having a lower capacity as compared to total requirement.
Yeah, it's a good question. So, spinning is lower because sheeting is lower. And selling any capacity in spinning, for the here and now, it was difficult because the absorption levels in the market are low and the pricing is, let's just say, inverted. So, therefore, since sheeting saw lower utilization, spinning had to also, mirror that reduction to some extent because of the nature of the yarn that we're producing for the sheeting division. And that same capacity is not something we can channel externally because of the current, let's just say, pricing structure because of cotton levels. So we've had to take that hit as well.
Okay. And so if I may ask, your inventory levels from raw material perspective at current utilization, do we have enough raw material, or we are procuring from, or we are importing or procuring inside?
We are trying to be as sleek as possible, but our inventory levels, as you have seen in March, are on the higher side. That's why I was telling the other gentleman that we need to sort of make sure that we actually achieve our stated results vis-a-vis working capital reduction, which given this volatility we have not been able to achieve. because of the slow offtake. So while our raw materials, lean and sleek, but it doesn't mean that our WIP and FG and other forms of inventory are as lean and sleek, which we have to work on.
Okay. Understood. Thank you so much and all the best.
With pleasure. Thank you.
Thank you. Participants who wish to ask a question, kindly press star 1 on your touchtone telephone. For questions, kindly press star 1. As there are no further questions, I now hand the conference over to the management for closing comments.
So thank you all for taking the time this evening and joining us for this call. I hope we've answered your queries, to your satisfaction. If there's anything that you'd like to know, which we have not thrown light on, just get in touch with us and we'll make sure that we've shared whatever needs to be shared in order to get you all on the same page. And thank you once again.
Thank you. On behalf of Elara Securities Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.